welcome back. We are here for another episode of Nobody Listens to Liz. I'm Leah Frederick.
I'm Liz Eric Geitz. I'm jumping. I thought it was in the line.
I'll shut up.
Now we can do the line. I think I made contact with Liz, and then I was like, I don't know.
Who are you?
I don't know. I'm Sierra Poliso,
and we're very, very excited to be
to welcome. I was about to
let me do my job. We're very excited.
Great wreck.
Well, should we do this again? Oh, I'm keeping this. Welcome Holly Matthews. You meant Holly Matthews-Houk? Yeah, okay. Wasn't sure. To our program today, our podcast. So, Holly Matthews, tell us about yourself. I didn't even do a bio on you. That's how prepared I am today. Yeah. How long have you been in the lending gig?
So I have been in lending real estate in general since 1998.
Were you even born then?
Yeah. Were you? Oh, gee.
I'm older than what you
Yeah, probably. Yeah. I got into lending in 1998. Now it's been a hot minute.
It has been a bit time. So, but we're very excited to have her here with us. She is a very experienced lender. I almost said agent. Yeah, sorry. We have all worked with Holly in different transactions, haven't we?
Yes. So I don't think we've closed them yet. Oh, wow. You've got to use her. She's fabulous.
She is fabulous.
Holly has saved my tail more times than I can count.
Yep. One of the things that I love most and why I always recommend her, even though I recommend many different options, my go-to is Holly, primarily because she does not have banker hours. And in a real estate transaction, you can't.
No.
We have been on the phone at 11 o'clock at night with a client.
Absolutely.
That was a tough call. And, she earned my eternal devotion because of walking that client off the ledge.
That was. Maybe we should apologize to Holly now while we're at Sayers. Very smart. Well, I don't mind. My family minds. My husband minds. I don't mind.
But it is true. You have to have a partner, particularly in lending, that does respond because it is a financial decision, and so you need to know kind of the ins and outs. So today we're actually going to be busting some myths. Here we go with that word again, myths. Regarding mortgage, though, the big, how do you really need 20% down, and other myths about mortgage, and that's why Holly is joining us today.
Thanks for having me. I appreciate it.
Absolutely. So let us jump into the deep end of the pool. All right. So you have to put 20% down to buy a home. I heard. Yeah. Which one? Myth one. Myth. Yeah, exactly. Tell us about all of that. What is typical for first-time home buyers? What do they bring to the table?
So typically right now, I'm seeing the overall average would probably be about 3 to 3.5%. And that's going to go between your FHA and your conventional loans. You have options on both sides. You don't necessarily need that 20%. And if you wait to save it, you're wasting time and valuable equity.
So you can get a conventional loan down to 3%.
If they will, 3% down.
Wow, that's amazing.
Not unheard of. And that's definitely a myth buster for me, because I really thought, okay, 10% I can see, but 20% I thought was what I grew up with. So,
yeah. And there's other programs, right, that are zero down.
Absolutely. There's USDA, which is all of Mason County at this point is covered by the USDA government lending program. That is a 100% purchase program. It doesn't mean there's no cash out of pocket, because there are expenses that
she keeps smashing it.
I'm trying top of my hand.
You're fun to have.
So that doesn't necessarily mean no money out of pocket. It just means that your down payment is zero.
Yeah.
Yeah.
That's really great.
And there's VA too, right?
Absolutely. VA is 100% as well, typically.
Yeah.
Depending on the veteran's particular exemption status, they can also get away without having a guarantee fee. We can go into all those details on another podcast.
Yeah.
Absolutely.
Right. So what is it now? When I bought my house, I actually got down payment assistance. I was FHA. And we've talked again about how it's amazing that my house actually went FHA, but I had a great lender. Shout out to Patty Trap. I didn't know how to that one too. And a great agent. And a great agent. That's right. So down payment assistance. Why is that it's not always the best option for a buyer? Tell us about that.
Sure. So right now, prices are what they are. And, you're borrowing 100% of the value. So if you're financing, that down payment assistance isn't always free money. Most of the time it's financed, and it's financed on top. Absolutely.
Mm-hmm.
It is not free. It is not just here's a check to close your loan. It is truly a financed transaction. It's a second mortgage.
Oh, really?
Yeah.
I didn't know that. Exactly.
So that's totally different than we get some grants sometimes. It's totally different than that, like Kentucky Housing or anything, Welcome Home, nothing like that. It's
Welcome to Kentucky Housing are very different. The Kentucky Housing is a loan. It's a secondary loan.
Really?
Oh, I didn't know that.
I didn't either.
Learn something new every day. See?
Yep. It is. Absolutely. You can get an affordable option where the second mortgage is that 3.5% at 1% interest if you qualify for the income level. Mm-hmm. But above that, it is paid back every month. And you'll have a second lien on your
And are you also paying private mortgage insurance? PMI?
You are still paying PMI.
So let's talk about that as a great segue, by the way. She gets that gold star. Awesome myth. Number 2, PMI. Why is everyone so afraid of it? What is PMI? And
in general, if you're going to pay PMI, if you're going to borrow more than 80%, the lender's going to ensure that you're going to be able to make that payment. That PMI factor goes along with that. Your FHA premium is a little bit less than the average conventional loan right now, above 80%. But it really depends on the buyer. I mean, that's all reflected in credit scoring, things like that. FHA is standard.
Yeah.
So it's one rate for everyone, and that covers that for you.
It was interesting to see the PMI in the breakdown of your payments. Because I bought mine, of course, I had it's FHA, so I had private mortgage insurance, PMI. And I saw what was going towards PMI, what was going to principal, and what was entry. I was like, I've never going to be able to add it off.
I have a question, might be a myth. So if you bought, pre-COVID, 2019, you don't have your 20% down yet from when you originally bought the house and what it appraised at. But now it's appraised at way more. So you have 40% down.
Absolutely.
So you mean equity?
Yeah.
So much.
All you have to do is call your current servicer, talk to them about your value. They may ask you to get an appraisal. They may actually hire an appraiser to do it for you. But if you're under that 80%, absolutely, they will they will drop that off on a conventional loan.
That's exactly what happened to me.
So if you've been in your house for, you say, few years,
or you've done extensive repairs, improvements, things like that, that are at one's market. I mean, that's exploded. Right. So they've, people are establishing that they have a lot of value in their homes. Give them a call.
That's exactly what happened to me. I've been in my house 4.5 years. And I bought mine very low. And I knew, based on seeing some of the sales in the area, because I worked with a great realtor, that the value of my house, you keep getting a shout out, even though nobody listens to you.
They listen to you, though.
I know. Because that's why we're doing it, why we're involved. So I went and I called my lender and I said, so I think the property values of my house have just gone up, and I really think it's quite a bit up. And so I paid for the appraisal, and I think it was under $300. They came out. One little thing I will say that was really great that my realtor recommended to me. Yes, because I listened to her. She said, I will write up some comps, have those comps there for the appraiser.
Yep.
And so I did more work for this appraiser than he did walking through that house. I spent more time actually doing that. And so your realtor can actually help and pull a comp sheet for you. So you can always reach out to them, ask to get some PMI. And it ended up that my house tripled in value. So we drop that PMI really quickly.
Yeah, if you've bought a house and you have PMI and you've never checked it out, you've been there a few years, you've done some repairs, pick up the phone. And when you say call your servicer, who are they calling?
So they are calling who they make their payment to. Because most of the time, that isn't the lender they close with. So pay attention to where your payment's going and give them a call. And 99% of the time, I mean, especially right now, with rates coming down, I know they're not pre-2019, 2020 rates. However, you can talk to that servicing company about refinancing it as well.
Awesome. So if you have enough equity, you could even refi, get some cash out,
reduce the PMI, all that stuff, get that out of there, and maybe save yourself some money paying off debt.
Yeah. And that's something they don't tell you, right? So I'm sure, do you have a conversation with people like, hey, you need to call and try to get your PMI off after you've paid so long or done so many repairs?
So it just kind of depends. I know when I personally bought my house, I only put 10% down because I knew the repairs I was going to do would increase the value enough that I could drop it off. And that kept that extra 10% in my pocket.
So you could make those repairs.
Yeah. So I paid PMI for a short time. And typically it's less than 24 months, they're going to ask for that appraisal. And so we did that right away, and it was boom, it went right there.
But people, after they're done working with you and buying their house, they may not realize or remember in a few years, hey, I can call and get that PMI off. So as realtors, it's a really good reason to reach out to your client and say, hey, you've been in this house for a while. I saw that you did some your repairs. Yeah, like, let's see what you're worth, and let's see if we can help you reduce your payment by getting the PMI off.
Absolutely. It's a solid service for your agent. Absolutely.
Awesome. I love that. Fabulous. Excellent. All right. So let's talk about, it's next thing is, waiting for 20% can actually cost you more. You mentioned that earlier about, we busted that myth. You don't need 20% down to actually purchase a house. So how do you see it costing you more, the time versus money kind of element?
So, for example, right now, what is the appreciation rate here locally in Mason County? Do you have an idea what that is?
Don't look at me.
And Mason County is one of the lower counties. Right. So, Miss Ed
was about 8,000. Oh, yeah. 8,000. So I don't know what the percent
is. That per 100,000 or per, what's that look like? If you're buying a $300,000 house today, what can you reasonably expect it to be worth in 12 months?
It was actually only $8,000.
Was it?
Yeah, $8,000 to $10,000 higher.
Yeah. So in other counties, in other areas, there's definitely a little bit higher of an appreciation rate.
Well, we're 20 years behind. Let's get the Mason County, Kentucky spot. Since you love this, yeah.
More rural aspects. Yeah, more rural.
Basically,
right?
Yeah. We got home phones?
Yes.
They do. And I paid their DocuSign for an agent because I was tired of having everything hands-on.
Wow. Yeah.
You can also go to your local real estate agent's office and pick up the keys to unlock.
You can for 100%.
Yeah.
Awesome.
My.
Yeah, I'm thinking about the 2000s today. One way.
Can you let those agents know word?
All right. So typically, though, in a more like urban Cincinnati or Kentucky, what kind of appreciation are we seeing more?
So I'm seeing folks that bought under 200 selling for pushing 300 up in Northern Kentucky.
Yeah, that's great.
And so not only does it, is it a good value perspective for those people, and they're likely at, 2 or 3, 4% interest rates. Mm-hmm. That's kind of why a lot of folks aren't selling.
Yeah.
Which we are going to address in a future episode, actually, about why, sitting on your 2 and 3 or 4% isn't necessarily a good idea if you have some things going on in your life, but maybe you should downsize and move.
Yeah. Oh, yeah, where you have a ton of equity.
I know, a ton of equity for another ad this game. So, hello, Silver Tsunami, I'm talking to you. That's a little missile that's out there. Okay, so buying now at 5% now, 6%. What's the difference? So, example, you don't want to move. Say, okay, last year was 7%, 7.25%. What's the interest rate? Difference? We're now 6.25% or so.
6.25%. I'd say you're at the high 5s, 5.5, 5.99 to 6.5 on any
Okay.
conventional loan rate.
All right. So what is the difference as far as making you do math on the fly, as far as waiting? Oh, I'm just going to wait, see if they come down another 4% to 4%.
So what's going to happen at that point, or what's projected to happen? I don't have a crystal ball, and I don't think any of us do. But what's going to happen is the market's going to be flooded with buyers. So now that $200,000 house is now going to go for $225,000 or $250,000, and so you're ultimately going to pay more. You might have a better rate, which doesn't mean you're but every year you're going to have a better payment.
Yeah. House rich, cash poor.
Yeah. Yep. So they're anticipating at least 5.5 million buyers to enter the market if it goes below 5%. Correct. Or goes to 5%, I guess is the prediction.
Right. That's a lot of people in the pool, folks.
Yeah. We don't want you to wait. We don't want to be.
Remember, she only likes working in the spring.
Sarah only works 3 months out of the year because we only sell houses in the spring. The best kind of sell, that's the only.
Oh, okay.
Yeah.
All right. So talk about, what you do need to actually buy a house. What is necessary? Because we've got a lot of people who are paying rent, almost, $2,000
Or someone else's money.
Well, no, good point. So, but yeah, they're paying, over $1,000. And that's what actually got me off the fence, because I was like, I'm not going to pay $800 a month when
And that was just $800.
that was $800, right? I was,
You couldn't get a box under $275 now for that.
exactly.
Not at all. Like, no, the cardboard box is available for $800.
Right. And so you have these people paying these rents, and they're not even thinking of home ownership. And we'll talk about that in another episode. But what is it that you need as a lender? What do you tell people? These are the ducks you got to have in a row.
Absolutely. So I think credit history is your first hurdle that you're going to want to look at. If you've had any late payments, anything like that, you're going to want to make sure you had at least a 12-month history of paying things on time. I know things change in your lives, and everybody has things that happen. But in truth, like, you've got to have a 12-month history of being on the ball with paying your bills.
Okay.
Whether that's rents, utilities, car payments, all of that stuff. And truly, like, I come from a financial planning background. That's kind of my wheelhouse. So I'm wanting to set someone up for financial success. I want them to have the ability to pay for their house payment, but I also want them to have the ability to cover an expense if something happens, because it always does. Whether it's a car accident, you need to replace your car, or it's the water heater goes out, you didn't buy a warranty, or those kind of things always happen. So you want to be able to put somebody that they're not on the skids as soon as something happens.
Eating ramen noodles.
It was the last 3 months. Yeah. Sitting on lawn furniture. Yes. And 100%. Like, you want to be able to establish yourself and have good financial success going forward.
Yeah.
So credit history is the first place I would start. I would just check your credit. You're welcome to call me or call any of the local lenders that you work with. Get an idea of what you're looking at. What is your credit score? What is your debt ratio? Those kind of things are really important. They all play into what you can buy.
Yeah. Debt ratio is the debt to income, DTI.
So how much income you have coming in versus how much debt you have going.
Correct. So a good general rule of thumb is if you're looking at, you have $3,000 coming in a month, so you have a $3,000 monthly income. Your total debts, including your housing, shouldn't be over $1,500 a month.
Okay.
That's a solid FHA approval.
Mm-hmm. Okay. 50%.
Yep.
So realistic monthly budget. One of the things I also like about Holly, and I was very appreciative of my lender too, was the fact that even though I wouldn't be ready to buy right now, I had some things I could do. I had a game plan. Like, you're going to make sure you pay this. You're going to, if this wasn't the debt and you say you didn't pay it, like, you're going to address that. You're going to fix your credit report. And so, but in 4 months, then we should be good to go. And so you really had, this information is education.
Absolutely. Yeah. And that's probably my biggest gripe and complaint is young folks coming in thinking they're ready to buy, and they have had zero true financial education. I think the area would
teach them.
They need to. When you're embrace that, how to balance that checkbook, how to not spend more than you make.
Yeah. How about the say you
can doesn't mean you should.
That high yield savings account.
Absolutely.
Yeah. Yep. I actually read my first financial book because as I said, taxes deadens my mind, right? And so, but I actually read a book recently. A shout out to Rich BFF. Ye, black her. She's so pretty. I'm both smack her.
That was a joke. That was a joke.
You're supposed to kick her when you make up.
But it was a book about finances and how to do it and what to do. And I've actually been giving that book to everybody. It's great. Yeah. So
Give it to me.
Vivian too. Okay, yeah. So shout out to Vivian.
Feel like Vivian. I watch her on TikTok.
Start your home buying journey by calling Holly Matthews-Houk, mortgage specialist with Union Home Mortgage at 513-227-9983.
A few technical difficulties, so we apologize for the sound in advance. All the microphones aren't working. Go figure. But you're talking quieter than I've ever heard you in my life. Oh, yeah. It still can pick it up. Former opera singer, I can project. So anyway, you guys say some opera. Good God. You don't want me to. You really don't want me to. I'm so out of practice. Okay, so what we were talking about is Holly. By the way, welcome back to Nobody Listens to Liz. I'm Leah Frederick.
I'm Liz Dykes.
I'm Holly Matthews-Houk.
Sierra Peluso.
And we're here to talk about the lending aspect of the real estate process. So Holly has joined us today, and we've gone through and taken care of like busting some myths with that myths. I know. See, I can gibbleless myths.
Enunciate.
Thank you.
So it sounds right. You don't need 20% down.
Don't need 20% down. Yep.
Myth busted.
PMI, which is private mortgage insurance, and why is it necessary, and why are people afraid of it? Sure. And how it works.
And how to get out of it.
Yeah, that's the important thing. And then waiting for 20% can actually cost you more. We talk about that. And the last thing is like what you do need to buy a home. So let's talk about that again. What is necessary? What's the first thing?
So first things first, I would check into your credit with a local lender, someone they trust, and figure out what you need to do. You need a 12-month pay history of having positive, payments and all that stuff there, and start and see what you need to do early. When you say don't shop first.
You say positive payments, you mean payments on time. Yes, payments on time. So pay on your credit card bills, your phone, your car, all that on time.
Medical collections aren't necessarily an issue, but making sure you're keeping up on anything that's hitting your credit, like collection.
What about student loans?
Oh, student loans have been a big issue here lately. So definitely want to make sure that you're paying those as agreed. That can affect your ability to government back loan.
Oh, really? I wonder, if you've been in default, does that count against you? Or if you had to defer, I guess more defer rather than, defaulting, but defer, will that count against you?
So deposit does not. What it does, though, is a lot of folks think that because they're in deferment, they don't have a payment. Well, we calculate a 1% payment against them. So if you have $100,000 in student loans, that's $1,000 a month that's counting against your debt ratio.
Oh, well, because they should be paying something, and when they select to repay, we need more room.
Yes, they won't be set out forever.
Gotcha. My goodness. Okay, so auto pay can be your friend with utility bills and auto loans and things like that to get that 12 months. At least.
Yeah.
All right. So we've got that. What about what's next? The budgets?
So definitely setting up a realistic budget. So you as a buyer are going to know how much you like to go out to eat. Do you like your Starbucks every day? What do you like to spend your money on? Because we're going to set it up to maximize what you can afford, but that's going to be pre-tax money. So, you know what you're paying in taxes. You know what you can realistically afford.
Yeah. Okay. And they can also tell you, like, no matter how much house I can afford, I'm comfortable with a payment of $1,200, $1,400, correct? And then you can kind of work that in, right?
Yes. The last thing we went into is put somebody into a house that they can't afford to live their life outside of.
Yes. We always say we don't want to sell you more than you can afford, and we definitely want to get you the best deal that we can.
Absolutely. All right, let's talk about the closing costs. Nobody budgets for that particularly, it seems.
with this industry.
I don't think people know about it.
Yeah.
They don't understand. And even if they do think there's closing costs, they don't realize how much. So what goes into your closing costs?
So essentially, closing costs are everything that comes into the loan that's going to cost you to close the loan. So you've got your lender fees, your title fees, appraisals, all those good things roll into that. You can generally budget for 2 to 3%, depending on the size of the loan.
Of your purchase price.
The purchase price, yeah. And we can also ask for sellers to pay that stuff. So that's a negotiating tool as well.
Although in usually a seller's market, that can work against you. So it is difficult, but there are ways around that. I know we've done a deal where we actually just raised the purchase price and then included that as the ask instead.
As long as the house will
appraise. As long as the house bid appraise and stuff. And we felt confident of that, and it did. So,
yeah, because let's say you don't have $10,000 to do your closing costs, but they increase their purchase price by $10,000. How does that affect their payment risk?
So essentially, it would be dependent upon your rate, but you're looking at maybe $50, $60 a month. So you're financing that piece essentially as well.
You still get the house, but yeah, paying $50 to $60 a month.
More of it.
Yeah.
Right. Yeah. Right. Okay. So, so the money for closing costs. And again, one thing mentioned earlier is that it's closing costs plus you have your down payment that you're bringing to
inspections as well. Inspection
is into those things too. Very good.
So the buyer can assume that they're going to need to pay for inspections first, and then depending on your lender, an appraisal.
Yeah.
Sometimes that's rolled into your loan, right? But sometimes they pay for that earnest, right?
Yeah.
Or does earnest money? What else do they pay for?
As we said, pest inspection. Certain loans require a pest inspection too.
And you might want a pest inspection, or like a septic inspection.
Yeah, for a septic, a lot of those things are big insurance triggers now that you want to have looked at before you go too far.
Insurance has changed a lot on the roof age.
It has.
My daughter's a big deal.
Mm-hmm.
Yeah. So other than that, everything's kind of rolled into the closing costs directly. And that includes your taxes. So your taxes, where we're at in consistent Ohio, they're prorated until the day of closing. So the buyer is responsible from the day of closing on, correct? And the seller is responsible for the taxes up until the day of closing.
Correct. And Ohio and Kentucky are different. So they're both paying arrears, but they're paying arrears significantly more so in Ohio than they are in Kentucky.
Are they?
Yes.
Yeah. Good to know. All right, so final things, any other myths that you want to add on to people or misconceptions? And if you have any that you're wondering about, actually, with a DM, send us a DM. What do you DM? I'm so unhip. DM us. Hello. If you have any questions about lending, I'm sure you'd be answer them. So send the DM to Holly, and we can send you more information. Holly also has an app that it can be real helpful, as well as kind of a guide to buying, like things you want to have on your checklist and stuff.
Right.
So DM us, Holly, and we'll make sure you receive that.
Absolutely. And I'm happy to help work with, young people that don't have that financial education to kind of get them prepared and ready to buy.
Yeah, well, and it's not even just young people, right? I sure understand older people. Leah bought our first house at 50. Yeah, didn't know how the process worked. Sarah had clue, didn't think she could ever buy a house.
Wow.
That's right. So I feel like the education just isn't there for people that could totally go buy.
Sure, Yeah, they're paying somebody's mortgage. Yeah, as I said. So, you don't need perfect credit. You don't need rich parents. You don't need a trust fund. You don't need 20% down. You don't need 20% down. You have a trust fund. I know, right?
We also don't need a 3% interest rate.
This is fair. We'll talk more about that coming up. So, listen, thanks for tuning in to Nobody Listens to Liz. And thank you again, Holly, for coming and joining us. I'm Leah Frederick.
I'm Liz Erdex. I'm Holly Matthews-Houk.
And I'm Sierra Calusa.
We'll see you guys next time. Bye.